first of all, let me do a quick introduction about what I'm doing and what my project is. I'm Eric Chen, CEO and co-founder of Injective Protocol, and we're working on scaling derivatives, especially decentralized central limit order book derivatives off of Ethereum and onto a layer 2 chain. And then next we have Joey. Do you have a quick second to introduce yourself?
I'm one of the co-founders of Augur. It's a peer-to-peer prediction market platform built on Ethereum. And then I'm also co-chief investment officer at Pantera Capital, where we invest, pretty much anything in the cryptocurrency space.
And next up we have Calvin.
Hey, yeah, thanks for having me. I am the head of strategy at Compound Labs, which created the Compound Protocol. And that broadly means I kind of lead all business initiatives over the past 3 years, joined since the very beginning. So I work with, I started work on education with crypto financial institutions, project and startup developers, and more sort of fintech and neobank startups from outside crypto, but in finance, which is a bridge we hope to be able to cross sometime soon. And yeah, I participate obviously in a lot of different DeFi and crypto protocols, do a lot of investing as well.
All right, and next up we have Yanwen.
Hi, I'm a co-founder of Perpetual Protocol. Perpetual Protocol is a perpetual swap protocol with AAM. So we design a very special virtual AAM that can provide leverage and long and short on top of the AAM. Happy to see everyone.
Last but not least, Hart from UMA.
Hey guys, I'm Hart from one of the co-founders of UMA Protocol. I look at UMA as a protocol to build synthetic assets on Ethereum. And yeah, Eric, thanks for setting this up and great to talk to everybody. See you guys.
So for the first topic, I was thinking about, let's talk about just in general, AMM versus the traditional CLOB MMs. So recently there were a lot of discussions around basically whether AMM's risk model is a lot higher than just in general, participating as an active MM. Obviously, there are some merits behind it because once completely automated, at least you have some sort of control to react. But just wanted to open the floor and talk about specifically, what's being misrepresented in the common discussions, and what do you think are pretty accurate and just kind of everyone agrees. Yeah, Hart, you want to start?
Yeah, man. I mean, I am kind of obsessed with AMMs as a concept. Like Eric, as you know, I come from a traditional finance background. I was a market maker at Goldman Sachs for treasury bonds, and for 8 years. The idea of an AMM took me a long time to wrap my head around. It didn't really make sense to me for a while. It really was from a traditional market maker perspective, it's a bizarre idea that you would let people trade with you at mid or with this fee around mid, and you're just going to algorithmically provide liquidity. Seems like something that from a traditional market maker perspective, your baseline case is you're going to get your face ripped off. You're just going to lose money because people are going to take advantage of you and your liquidity. But that's the wrong way to think about this. So as I've thought more about AMMs, I'm slightly obsessed with them. I think that they are truly a DeFi or crypto native invention. And I think that it is, well, it's not an invention in DeFi, but they've been proven to be useful in DeFi. And I think that the big mistake here is these are completely different concepts. Thinking about an AMM and a traditional order book or traditional market making, I think they really shouldn't be thought about as the same thing. They just do different stuff. And I'd argue that one of the most useful things about AMMs is its zero cost liquidity provision. So if you wanted to start a new asset or provide liquidity on some new market in the traditional setup, you need to employ a market maker to actually be there and make bids and offers. And AMM does that for free by just having people deploy capital. So I think that's one really important difference. The other thing that I might encourage people to think of an AMM as is it's not really about providing liquidity. It's about the liquidity provider saying, hey, I want to have a 50-50 portfolio of these two assets. And I'm willing to let people arbitrage me away to keep this portfolio always weighted 50-50. And I'm just going to charge a fee in between. And to me, that's a really useful service. If I just say I want a portfolio that's always 50% Ethereum and 50% USDC, I'm really happy to provide that liquidity and let a market arbitrage away, and I get paid a fee in between. That's like a really useful thing, but that's not the way a traditional market maker would ever think. So these are very different things. And I'll stop my rant.
Yeah, actually, it's super interesting because I've never really come across, CFMMs just in general before Hayden started working on Uniswap. I mean, like obviously Bancor, Kyber had some similar ideas, but really Uniswap was what brought into popularity. And I don't think people really think twice about just in general, like the CFMM until Uniswap really amassed a significant amount of liquidity. So I think right now it probably has one of the most robust risk analysis, arbitrage analysis, and just in general hedging strategies around it compared to any other kind of DeFi protocols. Yeah, Yewen, do you have any thoughts?
Yeah, actually, yeah, I totally agree with Hart. I think that it's totally different. And I think the other interesting thing is that actually the Uniswap is winning everything. I mean, Uniswap is kind of like the best baseline AMM for everything. I mean, it's just so simple. But also at the same time, we see like Bancor V2, we see, Balancer. There are lots of variations, but Uniswap is win. I mean, like wins everything. Compared to like Balancer, Uniswap just like goes like skyrocket. So I think the other interesting thing is that it's so simple that people can really understand this, and then there are lots of analysis on Uniswap, how to take advantage of the model, how to do liquidity provision. Become a liquidity provider. So I think being a very simple protocol like SYK is really, amazing.
Onwards to you, Kevin.
Yeah, obviously a very popular topic just the past few days, at least on Twitter, even more so. I actually like Compound's obviously not an AMM, though. I think first version of Compound launched before the first version of Uniswap launched. And I remember thinking Uniswap was like, oh, they're sort of taking like this algorithmic pricing of assets on a curve concept to trading. But so I'm not like super deep on all the nuances on the discussions that have been going down on Twitter, especially I think there's sort of like a range of perspectives from just the user to like the highly scienced sort of like mathematical optimization formulaic sort of perspective on AMMs. But when I look at it as a user, I love AMMs. I mean, what I care about holding a lot of illiquid, volatile assets that don't have markets for them is usability. And I think like both as liquidity provider, being able to like put idle liquid assets to work, even if I'm accepting some sort of risk reward where maybe the trade-off isn't as optimized as it possibly could be, or being able to trade like these illiquid assets, even with like big price slippage. Well, today in crypto, I think for a lot of assets, that's like your only option. You're just not going to be able to trade it on like order book types of systems. So as a user, I love that they exist. I think that, the perspective of a professional market maker is, I think, of course, going to be like sort of rolling their eyes or like even a little bit disgusted, like how unoptimized your positioning is if you're a liquidity provider or trader on AMMs. But I think it's just sort of like what Hart was saying, just a totally different goal. Like they're like serious about optimizing their risk reward and ROI. And then if you're participating in an AMM, you just don't care about that as much. You're taking like a different sort of bet. And then the last thing I'd say is like AMMs are evolving as a concept a lot. Like Yenwen was talking about the simplicity of Uniswap. I think it's already first gen AMM. Now you have Curve, specialized for stable coins. You have Balancer, specialized for other use cases, with really interesting use cases coming out too, like smart pools. I think you see like Shell protocol starting to come out, which wants to be, I think, even more flexible than Balancer. Pretty soon, I think AMMs are just going to evolve to be much more complicated and maybe much more tunable than they are today, to a point where like market makers will think, okay, there's actually more to optimize here, and I can do better with how I want to handle my risk reward. And then like the last thing I'd say is that central limit order books are also evolving. like especially as crypto grows and there's more liquidity for these long tail illiquid assets, over time, that model will be more successful as well. Yeah, we're really, really early on.
So yeah, Joey, obviously AMM has been researched pretty extensively, especially within the context of prediction market. And obviously there are, Hansen's logarithmic market scoring rule acting as kind of like a research backdrop for what it looks like for the constant function market making we see today on Uniswap. What kind of thought do you have, especially with regards to all the research you've done around prediction markets?
So I think there's a couple of interesting things about like automated market makers that come out of that literature. I mean, one realization is that with prediction markets, they're very volatile assets. So you may, will this certain team win a sporting event, and if the quarterback, breaks their ankle or something, the odds can change from like 50% to like 98% in a few seconds. And so if you look at stuff like Hansen's market maker, the market maker can literally lose all their funds. There's some stuff that we've been experimenting with at Augur, like surrounding like, what if you had like basically almost like a stop loss on an AMM, where it would just stop taking additional risk past a certain point. We're going to publish some stuff on that soon. I think that's interesting. I guess the other thing I'd say is, you earlier mentioned like what are misconceptions about automated market makers. I do think one misconception is like this idea, people have this idea, especially people from traditional trading backgrounds, that like if the price bounces around a lot, with very small movements super rapidly a ton, that you're just going to get killed as an automated market maker. And actually that's not really true. In fact, you'll make a lot of money in that environment, because if it bounces around a lot and then bounces back to where it started, that's actually the best sort of profit and loss scenario for an AMM. And so it's pretty simple. Like the math is really basic math. And so like if you sit down, it does take a few hours to kind of wrap your head around it and think through all the implications. I think if a lot of these folks did that, they probably wouldn't be so hostile towards the idea.
Yeah, I saw the Dan Robinson's tweet as well. That was pretty interesting. Basically, I think just in general, like if we just look at the model, or even if you don't want to do the math, at least like do the simulation or play around with the formula a little bit, even just on Wolfram Alpha, a lot of things will make a lot more sense. Yeah.
One of the things I'd love to see, Joey, would be like say you do your Trump coin or whatever, you tokenize the prediction market. And a Trump coin, if you were an automated market maker for that, like before the election, it trades between, I don't know, like a 35 and 55% probability. And you could pay fees along the way. But what you don't want is like, basically like as the results come in, you don't want to keep providing liquidity. Have you guys looked at building like some sort of AMM that would like pull your liquidity, like auto pull your liquidity ahead of expiration on a prediction market? Because I kind of think something like that would be really useful.
Yeah, I think I totally agree. We haven't done anything yet there. I think the MVP version is just get something generic out that works. And then I think you can add that functionality of pulling liquidity as like a little wrapper contract. But yeah, I think that's basically needed, because you don't want to be trading Trump after the election results are coming in. It's just a losing trade.
Yeah. So someone should build, Eric, let's get somebody to build this wrapper. I think would be a good idea. We get somebody to build this.
Yeah, let's get on it.
Yeah.
All right.
Actually, I think balancer, if you use smart pool, you can control that. You can stop it, you can withdraw, you can add more, liquidity to that. So you can programmable a pool. It's kind of like have a controller control the pool. So you can program that controller. Yeah, that's a new feature.
Yeah, that's a good point.
Which direction do you guys we should take this? Should we take this towards the futures direction, or should we take this towards DeFi farming and do like a review after the hype has kind of cooled down for a few days?
Calvin should decide. He's like the farmer, one of the original farmers.
Okay, well, farming then.
Yeah, actually, yeah, I think you guys would have the most robust data, because you guys are literally one of the OGs, well, the first to do this, and especially given that you guys are a much more liquid and much more established project with actual really strong fundamentals, the data set would be very valid. And I don't think there would be a lot of like convoluting variables kind of affecting it. For example, rug pull.
Yeah, although I have to give credit. I think a lot of people in the community would say synthetics was first, and I'm sure there's like cousins of the idea that you'll see throughout history. But yeah, when we kind of designed the comp distribution, there was zero. We didn't kind of foresee the farming craze at all. Like we didn't even think of it as like, we just thought it made sense for what we were trying to achieve for our product. And it sort of kicked off a bit of a craze, although I really think it's starting to die down a little bit, although it was an extreme fervor. So it's just slightly less extreme fervor. I'm really excited about the concept of liquidity mining. I think it's still in chapter 0 as a concept to be employed by like different products and protocols for different reasons. I think like the way in which I guess like tokens are emitted to users and for the actions that they're taking today is still really rudimentary. And over time, it'll get a lot more complicated and interesting. I think it has potential to be as complicated as sort of like online advertising is, just as an ecosystem.
Yeah.
And I don't mean to like necessarily draw a metaphor that it is advertising, although there is some like maybe customer acquisition element to it, but just like the transferring of value to try to incentivize people to do the things that you want. And with how programmable blockchains are, obviously, I think it could get to be like a really interesting space, like problem space, basically.
And would you say if you were to do it again, any type of parameter that you would fine tune, or like basically for distribution, is there anything you would have done differently, especially in terms of the drop frequency, or let's say the drop amount, that after, you know, this period?
Yeah, I think there's a lot we would change, and just from the perspective of like we were going in blind, and now there's at least several months of data and experience you can look at for things that have worked for other people or didn't work for other people. I don't know if I would highlight like any specific changes. The reason though that we were comfortable kind of going in with a rudimentary model that we knew was not going to be perfect, it was like a one big experiment, is because by also decentralizing governance of the protocol to comp holders, there's the possibility of upgrading that mechanism over time. So already, I think like Gauntlet Network, which is a really active delegate in the Compound ecosystem, they're sort of revealing a roadmap they have that's really related to the distribution of comp and potentially its utility. And what's further down that roadmap is blind to us, Compound Labs, which is as it should be. It's awesome that Gauntlet can sort of have as much of a say as they do. But so far, they've kind of led the way to reduce emissions a little bit. They thought that it was too fast, basically. And then now they're introducing vesting for comp that's distributed to users. And I think over time, they have other plans as well to sort of better use this mechanism. Right now, it's sort of a dumb, like, it's very gameable, obviously. Like the farming itself is sort of a game, but it wasn't intended to be. When the concept was introduced. They're one example of like one entity that's working in a decentralized third-party way to improve this distribution. And we as a Compound Labs can kind of contribute our ideas to the community. Hopefully they'll come up with better ideas than we would have anyway.
Yeah, I really like the slow release one. Essentially there's a vest for all of the drop tokens, right?
Yeah, like Synthetics did that to very good effect, I think.
I thought about like a similar situation. Basically, we were thinking about kind of tokenizing the share of the insurance pool, essentially early participants within like a futures market. And obviously this is mainly within the CLOB context. You can seed up the insurance pool with kind of like a pool share token, almost like, or like a representation of your pool share. And essentially as liquidations come in and also as proceeds come in, that will become effectively part of your yield. Obviously, especially for a responsive market, we need the insurance fund to be extremely robust. And the point of the insurance fund is to be taken out. It's not to actually gain a lot of yield. So we actually have to protect it from basically being withdrawn, like right before there's even a hint of like a black swan event or like a clawback event. So we were basically right now like working out the model for trying to find out a slow release schedule where it's both friendly to the early stakers and also effective to prevent any type of like kind of like fast pull before the insurance fund is mobilized. But it's still like very early in the research. I think that's something that we're going to be working on, you know, well into Yemlin. Obviously, you guys are also launching mainnet very soon. Or basically, like how is your current design of liquidity mining? Feel free to show your coin.
We will have vesting. I think that's the most different thing. I think when we announced the plan, there are not a lot of tokens besides Synthetic, actually, the first one. So have vesting. So I think vesting, personally, I think vesting is important, but I don't. But for most of the farmer, they don't like that. So I don't know the result. Actually, I think gaming is very important. Personally, I don't have a good answer to this, but I mean, when Compound first launched, there are lots of people. I mean, like they just share on Twitter that how I can like 2x, 3x, maximize my earning or anything. I think actually that's really cool. I mean, like people just like try different ways. If I put in like passive attention tokens, BAT, and then I can, and then I can fund this, and then if I put in something, and then I can get like like 100% APY or something. I don't know how to apply this to our protocol, but if I can have that, I think that's really interesting because people can share like different strategy, and then it's like that. They actually build a tool that allow you to like 3x your earnings. So I think that's actually very cool.
Yeah, it's, I mean, we have kind of the benefit of hindsight that the gaming has been really beneficial to the volumes on Compound and therefore hopefully one day the community. But so it's a little unfair of me to like say that it's bad. I definitely don't think the concept is bad. I am thinking a little bit from a longer term point of view, trying to communicate the benefits of something like Compound to somebody who doesn't know a lot about crypto, or maybe about an neobank who's looking at like 0.5% per year savings accounts and thinking, oh, how could I tap into this USDC savings account powered by Compound? And to have to explain like basically what's going on in some of these markets is, it's not something that I really want to have to do because it's sort of misleading about the utility and the original intention of the Compound protocol.
Yeah, I personally would think that, the gamification of it aside, we can't understand it as almost like essentially like a new user bonus in a sense, or like a kind of like a growth incentive. For example, like Uber, refer a friend, you get $100, or a bank, you open up a bank account, you get $500. Obviously, like crazy API wouldn't be sustainable in the long run, but it kind of like piqued every single user's interest. And especially over time, as more people join into this DeFi, understand this DeFi stack, and getting used to, for example, MetaMask, it's much more easier and much more seamless for a user to just start interacting with all the DeFi protocols. Because in my opinion, like the overall user experience for using MetaMask, for handling your own keys, honestly, is probably better than handling most of the custodial exchanges out there. But I feel like users are just not well educated on that front, especially for the broader crypto community or even the traditional community. So that's something that I think it's going to be very interesting to see how the space evolves over time as more of these users starts coming into the space.
I just gotta say real quick on MetaMask, I do think it's actually still hard to use for like average consumers or users. Like, I mean, I just think of my own patterns using MetaMask. I'm switching between a bunch of different wallets. When I do log into a dApp, sometimes you have to like click like 3 times to get it to connect to the right wallet. And then, once you are connected, a lot of times it'll broadcast a transaction. And if you need to bump the gas price, sometimes you get in this weird recursive loop where you need to do it like 20 times before it actually like doesn't fail. And so it's like, we're probably all numb to this and like, it just feels smooth. But I've showed it to like a few like novice users who like want to just do a trade on Uniswap, and it's still daunting. So I guess it's cool to see the product market fit that DeFi has when it's still this hard to use stuff like MetaMask, because you can just kind of envision like, wow, and that's easy to use. It can be really huge.
I think that's more of a product stability standpoint though, right?
Yeah, definitely.
Because I was looking at it from like a consumer perspective. It's like if we like line up the number of interactions required to, let's say, enter into a savings account, making a transfer, arguably, even though it's extremely unstable and erroneous, which is something that obviously MetaMask needs to work on, the number of interactions required, and I feel like the time or the total process is probably less than what we're used to the traditional stack. That's kind of like what I believe is pretty interesting, and that's going to be extremely bullish for the space in the long term.
Yeah, Eric, I'm too amped up to respond to this because I want to respond to like Kelvin talking about this being chapter 0 to start with first, and thinking about like what is the concept here, and going back to a little bit of like user acquisition stuff. Uber Eats and like Postmates did give out free food. It's like $100 of free food, come and use our service. And I actually love those deals because I know there's a venture capitalist on the other side that's literally paying me free food. And it like feels good, and you use it and acquires users, and there's some huge churn or whatever else. Kind of one riff of looking at this liquidity mining thing is it's like doing this type of acquisition thing where you're giving people free value, but it's of your own native asset. So like, to say it crassly, you like make up this money and you're giving people money and calling it, here's your free money, but you made the thing up. And that concept is like really wild. I very much agree with Calvin that we are like chapter 0 of how people are going to be able to use this thing to create other incentive structures. And I think it's like a really powerful thing. So it's kind of like meta concept. To be more concrete, if you like remember like Maker, when they first launched Maker DAI, they had a market making desk behind the scenes that was providing liquidity for DAI. And it was actually like annoying for them to do this. They had to like have all this like market maker infrastructure set up and they had capital and all this kind of stuff. You know, what it turns out what you could do now with this new concept is you still pay people, but you pay them with liquidity mining, and they provide unlimited liquidity for you, practically unlimited liquidity for you, to make your DeFi product usable, because there is like a baseline level of liquidity to make this usable. Yenwen's going to do this with the Perp protocol. It's like, it's very cool, like that concept. The thing that I wish Calvin and Compound did differently, and the same goes with Balancer, is that I wish, with the benefit of hindsight, they did do vesting from day one. Because like Yenwen said, like you couldn't predict this. So Calvin, like I don't totally blame you, right? But you couldn't predict this. But what has happened is that people farm and dump. And like Curve is kind of fucked this way because people just farm and dump Curve in massive size. And that's not actually good for anybody like that holds this native asset. So I hope that the kind of DeFi mindset, I hope all the farmers are going to actually get more comfortable with this idea of protocols moving to vesting schedules for distributing these rewards, and farmers actually picking something that they're long-term incentive aligned with, that they actually want to own the asset of. Like, I really hope that's a transition that people make, because Yenwen's right. Like right now, farmers hate the idea of getting a restricted asset because they want to farm and dump.
You're going to be pissing off a lot of farmers there. They're still farmers right now. Yenwen, you want to add on top of it?
Yeah, I think that's it's kind of like an experiment to us that adding a vesting. But actually, I have a question about the linear vesting. I mean, versus just like quarterly or like monthly. So you have kind of like a discrete event of vesting, or you have a linear one. I think I actually get like different advice on this. Some people think like linear one is better, and the other group of people think that you do the like quarterly is better. I think I got the concept from like Binance. They feel that doing the release quarterly is much better than linear. But I'm just curious about like your opinion on this, or like everyone's opinion.
My opinion is that you should absolutely do linear vesting here. Quarterly vesting or discrete events is just like an antiquated idea from, I think, traditional vesting schedules, where like it only made sense because of legal agreements or whatever else to do it on set schedules. Doing it continuously means there's no dates at which a bunch of liquidity gets unlocked. And since we can program this in a smart contract, I think it's strictly better. But Kelvin, what do you think?
I agree with that sentiment, basically. As kind of a user and a recipient of tokens, I very much like vesting. I did want to add one point to basically the concept of vesting generally. I think what's important, if possible, is keeping the utility of the asset. I guess what projects want to try to achieve potentially is making it not saleable or sellable. Like when we first thought about the comp distribution, what the goal was to do was actually decentralize governance. So we actually do want the token to be emitted to users as fast as possible. Now looking back, of course, it's a solvable problem to try to give them the governance rights, but maybe not have the token be transferable or sellable or tradable. I think then it's a balance of like us being a team of 14 people or something, and how much resources we want to put towards a particular problem when we really didn't know the answers to begin with. But now thinking back on it, I just think it's an important concept to think about if you're going to have vesting, to try to keep the utility of the token that was originally intended.
Yeah, I think that's actually a really interesting model. Maybe I forgot if it's scale or not, where they essentially launch like a proof of use. The token can be only used within the scale network, and obviously cannot be sold, transferred, and stuff like that. I think just in general, that's a really interesting concept. And I think in general, I feel like I started seeing a lot of projects, they're allowing locked tokens to be staked, or allowing locked token to participate in a consensus or government. I believe Compound is a similar case, right?
Yep.
Generally, we kind of have like an implicit, like non-transferable, non-sellable token that are still actively participating within the protocol. But I think we should like probably define it a little bit more, so that this way the users, or like I guess like future investors, would understand specifically the implications of it. Oh, Joey, so this is kind of asking you from like an investor perspective, like linear or quarterly or periodic vesting.
Yeah, so I'll give a little bit of a contrarian take. I actually like quarterly. It's a little old school, but the reason I like it is, so if you look at the recent projects that have launched recently, you see Polkadot, you see Filecoin. I'll throw Curve and Uniswap in there as two other examples. And if you look at Polkadot, it launched and it had pretty good price action out of the gate. It went up, kind of went down a bit, settled around, $4. I forget what it's trading at today, but that's kind of the range. And if you look at it from the investor psychology standpoint, because we're making these decisions as a firm, you look at it from that standpoint, you might look at an asset like Polkadot and you say, okay, we have this big pool of Polkadot. Maybe we want to sell a certain percent and then let the rest ride. And a lot of other investment managers are making similar decisions. People's percentages vary, but that's kind of how people think about it. If you have like perfectly linear investing though, the decision is always the same decision, almost, with a couple of rare exceptions. And the decision is, if it's linear, you just start selling immediately. And the reason is you have LPs, you have backers who are going to ask, like, did you sell any of this? Did you sell any of this asset? If you take Filecoin as an example, I'm sure I'm going to get like 50 emails from LPs over the next month. Did you sell any Filecoin when it was at $100? And even if you're not selling that much, say your target is long-term, you want to take 20% risk off on the position and let the other 80% ride. Well, with linear investing, it's constant sell pressure for the first, whatever 20% of that position releases. And a lot of people are going to have a similar psychology. But with DOT, everyone has their percent. It kind of gets washed out very quickly. And then the market can find pricing pretty quickly after. Anyway, that's my spiel for why I kind of like the old school discrete events. Even though like we can do it technically, we could make it block by block or anything we want. I think it's nice from a price standpoint in some scenarios.
Yeah, that's actually a really interesting take. It's kind of like a reverse dollar cost averaging, because it almost becomes like an interesting incentive, because you also know that everyone else participating within, let's say, Filecoin have the exact same vesting or the exact same linear vesting structure. So it's going to be kind of like a slow bleed in terms of like dump pressure, and that makes perfect sense.
Can I throw out a wild idea, Eric, just to get people's take?
Yeah.
That somebody else suggested. I can't take credit for this, but what if we were to structure things where the rewards were more like a call option? Let's say you could get your farming rewards are this token that is going to give you like one comp if comp is above $150 on some date. Otherwise, you get zero. Maybe that's a little extreme. But I'm basically saying you give rewards out that are only worthwhile if the project goes up. I'm only saying this as in like, I think there's a room for experimentation in this liquidity mining. Back to Calvin's point about this being chapter 0. Could we create an incentive structure where you get these tokens, but you really want to work hard to make the token value go upward?
That's actually really interesting, because in the sense that, well, first of all, you will have to apply some option pricing to calculate your EV. And it's essentially a binary bet where your option is going to worth something or nothing. I'm guessing how long of when's the expiry for these type of general option?
I mean, let's just say we did quarterly rewards. Let's use Joey's quarters again, and say you just had this form where your farming rewards, you got paid out every week or whatever to the nearest quarter, or something that's 3 to 6 months out. Let's make it even simpler. You make weekly options, and they're always struck like 10% out of the money. And so these rewards only worth anything if like the token price goes up 10%. And I'm only saying, like, you could imagine a whole range of structures here, but like from a governance perspective, it's really interesting, because if you got rewards for good governance, the idea should be to like further layer on the incentive that you want the compound governance holders, the comp holders, to make proposals that really do accrete value to comp.
Really interesting concept. I think I have to separate myself from the example being compound comp. I could see like that. It's again like sort of a game. I guess like in a lot of ways, a lot of financial engineering and trading is a game anyways, like at the heart of it. The cynic in me sees like ways it would quickly become corrupted. It's obviously there's like aspects of it that are solvable, even though on the surface they might seem tough. Like it seems gameable. I don't know. You might need like an Oracle system. You might need like, some people might call it another Ponzi mechanic. But like, I think any tool, it can be used for good or evil. But I think it's a really interesting concept for sure. The tying of rewards basically to like external events related to based on the goal of your protocol, which is probably like the success of the protocol, but it might not be the price of the token. It might be something else.
Yeah, like it could be total volume traded on like a Uniswap or type market, or like
that's
protocol.
cool.
It could be like something like that too.
That's crazy. That sort of goes to like what regulations and stuff would be around that. But if it's done in a decentralized way, it's like you're employing a workforce and you're sort of rewarding them with basically like equity in the protocol for doing real work, which I think is actually anti-security, which is a good thing.
Yeah, exactly. Like it's like making this an incentive structure. Again, if you can measure, like really quantitatively measure the goals of your protocol, and then put the incentives, then put the rewards where it's like, hey guys, you get these rewards if this core KPI, which, you know, you're right, Kelvin, like the default core KPI is token price, but it doesn't have to be that. It can be, you know, volume traded or, you know, total supply to comp program or whatever. These KPIs go up, you get these rewards. If they don't, you don't.
Yeah, don't mind me. I'm just writing down notes here.
I'd love to see that. I'm excited. I'm sure it's coming. Maybe, I mean, you're already thinking about it at heart, so.
There's nothing secret here, because I think there's also lots of issues with this too. Like, again, in this naive version of like this binary option, like Eric's right, it's this binary option. It feels almost adversarial to your farmers, right? It's like, you better hit this or else, right? That feels like, from a user perspective, I don't know that like I'd like that in this design space. I think the design space is really broad.
Actually, I think you can also structure that into like, you know, 50% of that is like just like normal, but 50% of that is co-option. We actually have this discussion like, for the vesting, we can have like, if you want to vest the token now, you get 100%, but if you can vest the token in like half year, you know, you can get like 150%. So you got more if you opt in to vest it longer. I mean, I just like different options, but I think that's also interesting because it kind of like you have a kind of like blended, vesting schedule, and then people can pick what they want.
Hart, did you get this idea from Green Shoe Options?
No, I got this idea from an OTC trading desk. The whole idea of actually just frankly like creating a new synthetic asset. So it's like, it was a kind of this meta idea. It's like, could you use UMA to actually like build like wrap a token for even other protocol to solve some of the problems that exist in yield farming? And right now, the biggest yield farming problem from a project's perspective is, you know, people farm your token and then dump it, right? So like Yenwin's point here is another like iteration on this. How do you create an incentive to have people hold your token because you don't want that selling pressure? And how do you create an incentive to have the farmers, like, I think if you think about how this should evolve, farmers shouldn't just look at their APY calculation, their spot APY calculation, and be like, oh, that's the highest yielding thing, I want to farm that. Rather, you want farmers that are going to evaluate the projects and be like, okay, wait, I like the ideas behind this protocol. I'm aligned with this protocol. I think it's going to go up in value. Even if it's not the highest APYs today, I think my net rewards, like my net payout, is going to be far higher because this protocol is going to win. And so you want to like create structures here are going to pick people who value the work you are doing on your project or your protocol.
Yeah, that's super interesting. One incentive I thought about this is that generally, like, I kind of had to make this decision recently as well. It's just working with market makers in general. I feel like none of you guys had to because you guys started off with AMM, right? So I guess I'm like the only guy in the room for having to decide this. But yeah, so generally, like, there were basically 3 types of market maker incentives that was kind of around in discussion that people were talking about. The first one was just a straight up buy, where essentially they just purchase a token from you and they'll just market make for you. The market maker would argue that this is a pretty well alignment of incentive, but essentially one thing we are concerned about is that it kind of marks that if the token does well in the long term, it kind of marks that kind of profit level that the market maker would want to take in order to cover themselves. The second really model is a loan plus a 2 call options generally. So essentially there's a loan on day 1 and there's 2 out of the money call options at some point in the market making period. And generally, obviously, we can even spread this call option throughout different periods to probably incentivize them as well. And this is, I feel like, arguably one of the more interesting ones and also the most complicated one, because essentially there's an incentive for the market maker to participate and not essentially act much maliciously against the project, because they also want to make sure that they have exposure to that call option as well.
Yeah, Eric, just don't let those market makers charge you too much for these services. So these are like, it's the loan plus call option, or the call on the loan is like kind of like an exotic derivative that I don't want these market making, these OTC desks to charge too much, man.
Yeah, been evaluating them. Still a pretty hard call to make. But I think by the time this video goes out, we probably have to make a decision. So just in general, like I think this is a more like high level question, because we've gone like pretty deep in the weeds about specific incentive mechanisms and just general like game theoretic designs for farming, or in what Tarun would call it, very high level and kindergarten level. But yeah, like want to kind of pull back a little bit and talk about the general financial stack. Like where are you really excited about? Like we started seeing like migration of traditional financial stacks or traditional financial products onto DeFi with its own DeFi twist or take. What are you guys most excited about?
Yeah, I guess on my side, I mean, there's a huge range of like products in this space now. Like almost anything that traditional finance has, somebody is working on some variant or twist on that in DeFi at this point. Whether it's lending protocols, people who are trying to like issue like these fixed style debt, interest rate swaps, perpetual dexes, that kind of stuff. Like every people working on everything. So I'm excited about that. That now there's like finally a lot of engineering mindshare on this stuff. I guess the other thing I'm excited about is layer twos are starting to become more real. As cool as I think automated market makers are, I think for this space to 10,000x in size, we need central limit order books in my opinion. And so I think layer twos are key to enabling that. And then I guess the last thing that I'm excited about is I'm excited about companies that are kind of like bridging the gap between centralized finance and DeFi. So companies that are building like fiat on-ramps, companies like Wire and CoinMe, basically let you get money into crypto, I think are kind of like, it's an overlooked problem. But, up until this point, people have really over-indexed on how do we get it to make it easy for people to invest in crypto? Like all the exchanges, they kind of surround that concept. There's very few people focused on how do we get people into crypto in like 30 seconds so they can go do this DeFi app thing that, their friend told them about that they think is interesting, completely independent of the price of Bitcoin. And that's going to be like the next big wave, I think. So I'm excited for that.
Yeah, wanted to quickly back the point. Yeah, like I'm a US citizen, obviously. So I remember like when I was trying to sign up for like Robinhood or like Coinbase and stuff like that, it always takes like 3 or 4 days, right, for the ACH to come in. But obviously there are other countries and regions where credit cards are accepted for like crypto purchases, where it's arguably a lot faster and a lot easier. But then, yeah, like I wish things would have been easier in the US.
As sort of a point to add context, I think all of us have been in crypto a relatively long amount of time, if not an objectively extremely long amount of time. And actually recently, I will kind of get to your direct question, but recently the sort of rise of interest in NFTs and gaming around NFTs and crypto art is the first time in a long time in crypto that I can think of where there was actually kind of a vertical or a sector of crypto that I'm interested in that I just don't have the bandwidth to learn about. And at first, that makes me a little bit sad, like, oh, I want to know everything that's going on in crypto. Of course, it's a good thing. Like as the ecosystem grows, there's going to be more and more areas that I just can't know about that not everyone can know everything about. And so I realized, okay, I guess I will sort of specialize in DeFi. And that used to seem obvious because DeFi seemed like the only thing really in crypto. But I'm excited to see basically more and more verticals kind of pop up for me not to know anything about. And I say that more just to say that like even within DeFi, there's like Joey was saying, such an expansion of new products and ideas that it's hard to like pinpoint what I'm excited about, except at a very high level. The answer I'll usually give is like basically more assets, more interesting assets, synthetic assets, and new ways to package them into interesting products, especially from like an AMM perspective or a liquidity provision perspective. Really excited like right now to see the evolution of like Uniswap v3, which I don't know. I've only heard like rumors about what is involved in it. The next evolution of Balancer, all the new AMM or order book dexes coming out, like Perpetual, like Injective. I think it's pretty clear that like OKX, BitMEX, there's product market fit to be found here, gigantic product market fit to be found. So yeah, I'm really excited to never have to use like Google Authenticator again or never have to enter a password. I mean, besides that, I'm also really excited actually on other layer ones. Joey mentioned, I actually both Filecoin and Polkadot. I think it's inevitable that the future is as many chains, and it'll be interesting one day, not just a bridge like Ethereum to Polkadot, Ethereum to Solana, Ethereum to Filecoin, but actually like Filecoin to Polkadot, or like Filecoin to Handshake. And what does that world look like in the future?
Yeah, onwards to Yenwin. Please don't say perpetual.
Just like Joy and Calvin, I think that there are lots of teams trying to bring a traditional finance instrument onto DeFi. So yeah, I think that's really interesting. I don't really know. For me, I always have this question like in DeFi, AMM, or a very simple. I think the automated market maker is actually very interesting, kind of like an option to me. I'm not a financial background, but I mean, options is actually very simple. But if you really think about like how to hedge on the option, it get really complicated. You got like delta, delta, gamma, lots of different concepts. And then I heard about that. I really just like cannot really understand like 20% of that. But I think AAM is very simple. But if you think about like how to hedge on AAM, I think actually it get very complicated. It's kind of like option. So I would say that I want to know like because we don't really have a very efficient option market on DeFi yet. So I'm really interested to see if we have option. We have this traditional finance element in DeFi and also like new AMM. Actually, AMM can do lots of different things, and then it can get as complicated as option if you want to hedge. So I just want to. I mean, very interesting to see like all these like traditional and new financial instrument, and then they can kind of like blend together, and then or we use traditional instrument to hedge like AMM, or use AMM to hedge option. Actually, I don't know, but I think that's actually interesting.
Yeah, it's time to bring back Cinch. I think if Cinch were to launch today, it would be a very, very interesting product where everyone would try to farm, to say the least. Onwards to Hart.
I'll go quick. I mean, I think honestly, I'm excited for prediction markets. I'm still waiting for like that whole thing to explode in this way that I think it should and will. I think layer 2 can help make that happen and like more scalability there. I really think that there's a lot that could happen in that space. Calvin, I'm excited for Compound V3. I don't know what that's going to be, but I'm excited for whatever that is. And like you said, I think Uniswap V3 and then Yenwin, like all these automated market makers, that automated market maker concept, like I think exploring the automated market maker concept and where it goes and how you can optimize it, or like different designs, I think that's going to be fascinating. I think exploring the yield, like again, innovations in this yield farming is going to be fascinating. And then Yenwin, like your perp protocol, like I think it's pretty brilliant design. So I am actually quite excited for mainnet on that too. And I think we've got this space now where the froth, the disadvantage of the yield farming mania is like this froth that I think doesn't feel great, but it's part of the cycle of cycling a lot of new brain power into domain. And it's cool that we like have this sucking, this just the thing that sucked a bunch of new talent into the crypto space that I think is going to bring its own set of fresh ideas, which will be fun to see here.
Yeah, that's really what we're looking forward to. More smart people coming into the space. Hopefully they don't front run all of us, but yeah. Let me do some closing remarks. So generally, for what I'm really excited about is a generalized hedging strategy, first of all, for AMM. I started seeing a lot of research popping up, trying to contain at least IO a little bit, and then at least making the AMM strategy kind of augment the profitability of being an LP. So I would say that that's something I'm looking forward a lot to, because we start seeing a lot of different new AMM designs, but the LP reward, or kind of like the LP incentive, some of them are, I would say, masked by the fact that there's a liquidity mining incentive behind it. So a lot of times it could be LPs could be operating at a net loss in the long term, but the liquidity mining incentive made it worth it for the LP. So it's essentially like delaying like some of the fundamental design problems that could have. Obviously, this is not like Uniswap and stuff like that. It's just like people are like messing around too much with the curve, where this is something that could happen. So I'm definitely looking forward to like hedging strategies around that, and just in general like options. Building up the derivative stack and scalability, because I think a lot of the current designs kind of started off with, here's a constrained blockchain, how do I build something that's fully decentralized and arguably fully on-chain from that point on. And once we move it to layer 2, where arguably a lot more things are much more flexible, you can be a lot more free when it comes to design different like infrastructures. Like for example, like on-chain order book just doesn't make sense on Ethereum, but it would make sense on layer 2. So yeah, just in general, I think as more projects are delivering, as more, especially like layer 2 infrastructures are being set up, for example, Optimism, really can't wait for how the space is going to look like in 3 months. Never a dull day in crypto. So much everyone for joining this session. I think it's really a fun time, and we might have just came up with a new DeFi protocol. We'll see from that point. Really appreciate you guys being here.